there'll be opportunities in the future. There are times when they're easier and there are times which are harder.
From 1962 to 1975, Charlie Munger, through his investment partnership, generated a compounded return of 19.8% per year for a total 13-year return of 947%. And if 20% doesn't impress you because you're used to seeing the market go up at 10 to 20% per year, he did this while the Dow Jones Industrial Average returned a measly 5% per year for investors. So, in today's video, I'm going to share with you 5 investing principles that Charlie Munger used throughout his career in order to generate massive amounts of wealth in the stock market. I put a ton of effort into making this video, so if you do enjoy it, I would very much appreciate it if you could hit subscribe or just leave a comment down below. Rule number 1 for today is that there are 3 baskets for investing. Yes, no, and too tough to understand. And this is something that every value investor should be thinking about when they're approaching their analysis of businesses in the stock market, when they're looking for businesses to add to their portfolio. Which basket does it fit into? Is it a yes? Is it a no? Or does it fall into the too tough to understand? And in terms of that too tough to understand basket, most of the businesses that I come across and most of the businesses that every investor comes across falls into that basket. And that is absolutely okay. Don't be worried about missing out on investing in some great company that's going to be very successful if you don't understand that industry or how businesses operate within that industry. There are plenty of businesses out there in the market that are within an area in which you understand, an area that you are capable of understanding and capable of making accurate predictions about where those businesses will go in the future. So don't worry about what is going on outside your area of competence. Just focus on what's going on within your area of competence, and that way you're always going to be making very smart bets in the stock market. A lot of people get into the trap of looking for value businesses in areas that they don't understand. People kind of get impatient. They're looking in their area of understanding. Maybe it's a small number of consumer related businesses that you might have been a customer of. And there's no businesses at the moment. They're sort of looking and they're not finding any bargains. They're not finding anything that's offering them a good return, any great businesses at a great price. But then they kind of look out for a little bit and they see that a lot of value investors are looking to this pharmaceutical company or this healthcare company or this financial company. And even though they don't understand it, because they think other people are seeing value there, they go and try and invest over there. And that is the biggest mistake you can possibly make, because as soon as you invest outside an area that you don't understand, as soon as you invest in an area that you don't understand, I should say, you get to the point where you don't know how to make decisions in that area. If the stock price goes down, you don't know if you've made the wrong decision. If the stock price goes up, you don't know if you've made the right decision, because you don't understand what makes businesses grow in those areas. So it's super important that immediately, as soon as you come across a business that you don't understand, just forget about it, or spend some time learning about that industry before you start investing in those businesses.
Much of what is taught in modern corporate finance courses is twaddle.
Number 2 for today is that excessive diversification is madness. This is a famous quote from Charlie Munger, where he believes that if you're being excessively diversified, if you're diversifying more than 5 to 10 businesses in your portfolio, he says that you're crazy, that you're mad. So why does he think that? And why is that view so different to many of what people would say in traditional finance? If you go to a financial advisor, if you go to speak to anybody in traditional finance, in corporate finance, they will tell you that the best thing that you can do is diversify as much as possible and buy as many stocks as possible and have as many stocks as possible in your basket. So what is the difference between those views, and sort of how do they differ, and why is Charlie Munger correct, and why is traditional finance wrong? And the core reasoning behind Charlie Munger's approach, which is to diversify over a small number of businesses, but not a large number of businesses, is that we are limited in our capabilities as humans. We have limited resources, and there's only so much research we can do, and there's only so many businesses that we can understand. And as a result, once you start going into the 25th, the 26th, the 50th business, the 100th business in your portfolio, you're no longer keeping track and analyzing the businesses properly. You need to know everything about the businesses that are in your portfolio, because you need to be able to make decisions about whether to keep them or whether to get rid of them or whether to add more or whether to reduce the position. And the only way that you can do that as an individual is by holding a small number of businesses. There's kind of this theory that if you have, huge diversification, you can limit your risk. And that is true to a certain extent. But when it comes to unsystematic risk, the risk that is associated with individual businesses, you can eliminate the vast majority of that risk with 5 to 10 businesses in your portfolio. And beyond that, adding more businesses to your portfolio really only gives you marginal decreases in unsystematic risk. And what it does not eliminate is systematic risk, which is the risk of being in the market itself. And that's something that you cannot eliminate. It's something that diversification cannot eliminate. So once you go beyond 5 to 10 businesses, you're really not seeing any gain in the lowering of risk. And in my opinion, and in Charlie Munger's opinion, and many other value investors' opinions, once you start adding more businesses, you're actually increasing your risk. And the reason why is because you don't understand the businesses that you're investing in. You're just adding more businesses to your portfolio. And yes, if you add another 50 businesses, maybe you can reduce your unsystematic risk by another 3%. But how much have you increased your risk by being exposed to businesses that you don't understand? The difference between traditional mainstream finance that they will teach you at university and value investing is that traditional finance looks at statistics and they treat stocks as a statistic. They don't treat them as businesses that produce cash flow. They don't think about the fact that if you don't understand the businesses in your portfolio, then you are massively exposed to those businesses and the risks associated with them. And it is much better to find a small number of businesses that you thoroughly understand and invest larger amounts of money in them, because you're going to eliminate your unsystematic risk between those 5 to 10 businesses, and then you're going to have the best chance of growing your portfolio at a large rate if you understand what is within your portfolio. Number 3 for today is that the big money in the market isn't made when you're buying, it isn't made when you're selling, it's in the waiting. And this is a really important one, and it's something that holds a close place in the hearts of value and long-term investors, is that most of the time we're just waiting. Most of the time we're not buying, we're not selling, we're not trading in and out of businesses, we're not trying to time the market and do this and do that. We're just waiting. And we're really waiting for a couple of things. The first thing we're waiting for is for great businesses to come on sale. Great businesses do not go on sale every day, and it's very rare that it happens. You might find 1 or 2 great businesses in an entire year or in a 5-year period that meet our requirements. It's a very, very disciplined approach that means that we're waiting for the very, very best and the very, very safest investments that are going to make us 10, 15, 20% per year. And this means we have to do a lot of waiting. We have to wait and wait and wait and wait until something dramatic happens to the businesses that we understand. Every now and then, some kind of short-term problem will come across a particular business, and their stock price will go down in the short term. A recent example of this, some of you may be aware of what happened with Facebook last year. Facebook stock dropped 45% in the space of about 6 months due to some uncertainty surrounding a governmental investigation into some of their policies and some scandals that happened with them. And a true value investor would have recognized that during 2018, the value of Facebook's business over the long term did not drop by 40%. Maybe it dropped a little bit, but it certainly did not drop by 40%. And some people took the opportunity to invest in that company. I was one of those people who saw that opportunity to get into a really great company at a substantially cheaper price. And then the other type of waiting that we will be doing in the markets is that we will be waiting for our businesses to grow and produce cash flows. We're not going to make money immediately in the stock market. We might be in positions, in stock market positions that go down for the next year or two. They might go down for 3 years. They might go sideways for 5 years. There's a lot of waiting and patience that is required when you're investing in businesses that are going to be successful over the long term. Business productions and how much cash flow they produce are often very inconsistent. And what is happening in the short term is very much what's going to affect the stock price in the short term. And you need to be able to weather through that and have the patience to wait, not be so agitated that as soon as your stock goes down a little bit, you have to sell it and find a new one. Because if you're constantly doing that, you're going to be constantly chasing the wave, and you're constantly going to be selling when a business is going down rather than what you should be doing, which is buying more. Number 4 for today from Charlie Munger is to quickly identify mistakes and take action. And this is something that's really interesting because there's a fine balance between being quick in your actions based on your emotions and being quick in your actions based on rationale. So let me explain what the difference is between those two. One of the biggest mistakes that people make in the stock market is that they lead with their emotions, meaning that a stock that they invest in, it goes up for a couple of months, they feel good, and then the stock drops by 30% over the next few months and they feel panicked. They feel like they did something wrong. It's a real feeling in you. Anyone who's been investing for more than 6 months and had a stock kind of drop substantially knows the feeling. But ultimately, that's what it is. It's a feeling. It's an emotion. It's not based on anything. And the emotional investor will follow that feeling and sell those businesses. They will think they're doing something wrong. And that is not what Charlie Munger is talking about here. He's not saying if you feel like something is going wrong with a stock, you should sell it immediately, take action, be decisive. That's not what he's talking about. He's talking about the rational side of investing. And that means that if something has gone wrong with our analysis, if something's gone wrong with the business that changes the analysis, that makes it no longer a great business at a great price, then you want to be decisive. And there's a few key factors that we can look out for in order to make sure that we're being decisive in our actions. The first is that if we no longer understand the business, we need to get rid of that business out of our portfolio. Remember, we need a small basket of businesses that we thoroughly understand. So if one of the businesses in your portfolio starts moving into a new market that you don't understand, maybe it's cloud data or financials or something like that, then you no longer want to be in that stock. If you don't understand it, you don't want to be invested in it, because the moment you don't understand it is the moment that you don't know where that business will be in 5 or 10 or 15 years down the road. The second reason you might want to be decisive and sell a stock is if it no longer has its competitive advantages. You might have bought a business because it had substantial market share and it had economies of scale as an advantage. Maybe it had a unique branding position in the market. It offered something unique, proprietary that no other businesses were offering, and as a result, it was attracting customers. If the business no longer has its competitive advantages, then it's no longer a business we can be confident will be sustainable over the long term. And as a result, you should be decisive and sell that business. And then thirdly, we look at management. And if management is no longer meeting our minimum requirements, if they're no longer trustworthy, if they're no longer investing effectively within the business, and if they're no longer keeping debt to a low level, then again, you want to be decisive in taking action and getting rid of those stocks out of your portfolio. And that is something that is very, very different. That is something that's so different from being an emotional investor and sort of taking action based on your emotions. If you make a decision based on a stock price movement, you're more than likely you've made a mistake, unless it's because the stock price has gotten cheap enough for you to invest in. Most of the time, if a stock drops and you're selling it, you need to ask yourself why. Why does it matter that the stock's fallen in the short term? What has it changed? What has changed in the underlying business? So making sure that you are understanding when you're being rational and when you're being emotional. And if you're being rational, be decisive and take action. And the final rule, and arguably the most important rule from Charlie Munger today, is that the only way to win is to work, and hope to have a few insights. And I really love this quote because it is so true. At the end of the day, what will allow you to win is by working more than the people around you who you're competing against. Investing in the stock market is the same as anything else. It's a competition. It's a competition between who knows the most about the businesses that they're investing in. Remember, whenever you buy a stock, there's someone on the other side that's selling. And whenever you sell a stock, there's someone on the other side who's buying. So there's someone who has the complete opposite opinion to you about a particular business when you're making an investment. And that means that you're constantly in competition with other people to go against the consensus. If a stock is going down substantially, it goes down 40, 50, 60% over the course of a couple of years, then that means that most people investing in the stock market believe that the business is worth a substantial amount less than it was previously. And the only way that you can beat those people is by understanding more about that business and knowing something that they don't know and seeing something that they don't see, so that you have the confidence to buy that business when no one else wants it. And you can sell it to them back when everyone wants it and the stock is overly expensive. And the part in this quote about hoping to have a few insights, again, sort of comes back to the fact that as value investors, we're going to find very, very little investment opportunities over our lifetime. Warren Buffett talks about having a punch card of 20 businesses, meaning you can only invest in 20 businesses over your lifetime, so be very, very selective. And 20 businesses over a lifetime, for many people, will mean finding one business every 1 to 3 years for the most part. And that's really hard for a lot of people to grasp. They start investing, they look for a month, and they expect to find something. You might find some great businesses. I hope that you find some great businesses, because there's great businesses everywhere. But finding a great business that's at a price where the risk is really low, but the return is really high, that's something that's really rare. That's something that doesn't come along very often. I know for myself personally, I've been investing probably for the past 3 years, and I think that I've probably found 2 businesses that I'm very, very confident in that are in my portfolio, and maybe 3, but mostly 2. And I mean, I found more businesses that are great, but businesses that are great and at a great price, I think I've only found 2 of them. And that's something that's a reality of investment analysis that you need to accept, is that these opportunities don't come along very often. And you just need to continuously be working, be willing to continuously look for businesses, have the patience to wait for great businesses to come on sale. And when they do, take action, and that's the way that you're going to be successful, according to Charlie Munger and many other value and long-term investors. So that's all we've got time for today, guys. I hope you enjoyed this one, and if you did, I would very much appreciate it if you could hit the subscribe button or just leave a comment down below. Any of those things help me out a ton. But for now, guys, I will see you in the next video.